All right. Welcome back, Jared. How's your day going, man?
Good, dude. How are you? It's been a couple weeks since we've done this.
Yeah, it has been a couple of weeks. We've been busy, I'm assuming, which is a good thing.
Heck yeah.
But there's a lot of stuff changing in the real estate market, so we want to keep everyone updated. First off, my name is Thomas Miner. I'm a realtor with Exit Realty North Star in Norwalk. Jared, you want to introduce yourself?
Yeah, Jared Nicolaisen with Key Mortgage Group out in Urbandale. Loan officer for them.
We're both real estate experts that mostly work in the central Iowa area, and we're here to tell you about recent real estate news. And we've got two articles that we're going to talk about today, more national focus, but we'll kind of bring it back and talk about what's happening directly in our market as well too. As we go through stuff.
Yeah,
So
absolutely.
the first article that I had pulled up is Lawrence Yun, who works with the National Association of Realtors, is one of their economic experts, talked to the Congress about how the market won't improve without action on supply. So what he's really talking about here is currently with the raise of the Fed rates, they're trying to slow down the buyer demand a little bit to give a chance for seller supply to pick up, but they're really not fixing the issue of making it easier for people to build homes, making it easier for people to fix up old homes, and making it which would and then would affect make it easier for people to transition from the home that they're in to other ones or to new construction and stuff like that. So they're just slowing down the market right now, but they're not really solving the core root of the problem.
Mm, yeah.
So I wanted to kind of step back and talk about the current market that we're in, which I wouldn't say interest rates are high because historically they are still low, but we're in a market right now that interest rates have jumped quite a bit in the last 6 months. Um, but the prices haven't really gone down yet from what we see. So,
hmm
in your opinion, Jared, who do you think, what type of client, what type of customer is most affected by that type of market?
Yeah, I would say because the real issue, obviously, with interest rates going up and if prices are going up with it, then it becomes an affordability issue, not a high interest rate issue. So, with that, you're going to see some first time home buyers get priced out of the market a little bit just because that house that was, 200,000 that had a payment of, let's call it 1,300 6 months ago may now be 1,500. And, if you're just graduating from college and you have a car loan, some student loans, $200 a month can be a big difference.
Yep, that would really start to mess with your debt to income ratios,
Yep.
and it would bring affordability down. And just your typical first time home buyer isn't going to be bringing as much equity either. So when interest rates jump and you're in a lower equity situation, interest rates affect you a whole lot more than someone that would be bring equity.
Right.
So it seems like to me, from what I've seen, is the people that are less affected by this and still being aggressive and going out and buy a home if they want to change their living situation for any reason are the people that are bringing a ton of equity. Um, Whether they have a home that they're selling that has been affected by how much appreciation we've seen the last few years, or whether they've just saved up a lot of cash for whatever.
Yeah.
Those seem to be the people that can still take advantage of this market.
And it's funny that you say that too, just because the you say, there's so many factors, and they'll probably go in with the next article. There's so many factors that play into the market that we're in right now that, it's not just interest rates that's gonna bring down demand. Once you have more supply, prices kind of stabilize once there's a ton of or a lot more inventory. Just because, what's the number, Thomas, that like we're in a seller's market, but if you reach a certain point, it flips to a buyer's market in terms of homes on the
So
market.
So the what you'll commonly see people talk about is having a certain amount of months of inventory. And so
Yes.
basically what that would mean is if we were not to get any more inventory in our market, how many months would it take us for us to theoretically sell out of that inventory at the current rate that we're going? So for resale homes, so not new construction, we're still seeing pretty much across the Des Moines area in general, we're still seeing it's just above 1 month of inventory. So that would be considered a really aggressive seller's market. Once you start getting into 3 months, you'd be looking at a neutral market. Once you start getting to 5 or 6 months of inventory, you would start getting into a buyer's market. So for resale homes, we're still in a strong seller's market and interest rates have gone up. And a lot of your resale homes are the ones that would fall into that first time home buyer situation. So, I mean, you look at different market factors, you look at inventory, you look at interest rates, you look at buyer demand in the area that you're selling in, and you look at what type of sellers would be interested in selling. And where we're sitting at in Central Iowa right now is a lot of people that own homes have really good interest rates on them because in the last 2 years they've refinanced and got good interest rates.
Yep.
So unless they're dying to downsize or upgrade into a new construction, they're probably not going to be moving because Central Iowa is growing in population. There's not a mass exodus in Central Iowa right now. And with how strong our job market is here, I don't really foresee that happening anytime soon. Buyers are still very interested in buying because the people that are living here can see themselves living here a long time.
Yeah.
So that would increase their willingness to buy here. And interest rates have gone up quite a bit in the last 6 months.
Yeah.
It has slowed down buyer demand a little bit. But a lot of the buyers I'm talking to can kind of see through the trees and see the forest a little bit and start seeing the big picture. If they get a monthly payment that they're comfortable with at the current rates that they are now, I hate to promise it, but theoretically, it's only going to get better. Would you agree with that?
Wholeheartedly. That's I mean, you can throw out the R word out there, recession, and usually with recessions, rates go down. So part of that would be if you let's just say you locked in. I mean, I have someone that locked in a 6.5 not too long ago. The likeliness that they're gonna keep a 6.5 for a very long time is pretty low. So
Mhm. And was it a fixed rate mortgage?
yep, 30 years.
Yeah. So they know under no certain term. I mean, they know what their monthly payment will be for 30 years. It'll only get better. They didn't lock themselves into an arm, which there are situations where you would want to go with an arm, but
Yep.
they fixed it and they know what their monthly payment will be. And as long as they're comfortable with that, they're only going to refinance if it's better. They're not going to refinance into a worse rate.
Right.
So,
Yeah. But I mean,
and
here's what I will say though too. So, and I'm gonna give you a scenario here because I know that the high rates thing, a lot of people are worried about it, but here I'll give you a scenario where it may make sense to refinance into a higher rate. Not saying that people should, but there could be an opportunity. So let's just say that you have a $200,000 house, you only have 100,000 left on the mortgage, and you have a truck with $30,000 left on it, $600 a month, and then you have, credit card, student loans for another 30,000 that have, another $600 or another $400 a month in payments on it. So you have $1,000 a month, and let's say your mortgage is 1,200. If you refinanced and went up $200 to $300 a month, but you pulled equity out and paid off all that debt, you theoretically saved, $700 a month in actual
mhm.
payments. So just because the rate might
and
be higher, you did actually save money there.
and like even if it's at a high interest rate, it's for sure better. It's a better interest rate than what your credit card is. It could be very, very close, if not lower than what your current car loan is at.
Yep.
Some of the car loan interest rates have been really good lately that I've seen, but it could be lower.
Right.
You just kind of have to look at it all from all situations of that. But back to the market factors thing, the only thing that's really shifting it to more of a buyer's market right now is the increase in interest rates.
Yep.
Everything else is still creating the seller's market, and they really
Right.
haven't figured out how to get the right inventory of homes and get it on the market quickly. Because if you look at new construction right now, a lot of what they would consider their first time home buyer homes, those sales have slowed down because of the increase in interest rates.
Yeah.
So the inventory they're actually sitting on right now is their lowest price homes, and they're currently having no problem selling those higher price homes because those are more than likely people that have a ton of equity to bring into a new construction home.
Yeah.
So it'll be interesting to see what happens the next short term, which I would consider like 3 or 6 months, what kind of resale inventory comes on the market and what's staying? Because currently it's shifted a little bit. I'm seeing a lot of homes that need work are sitting a long time, and new construction isn't selling as quickly. So it'll just be
Yeah.
interesting. What have you seen as far as mortgage application wise? Are you still seeing about the same rate? Does it seem
Yeah.
is there anything you're looking at that seems like there's still a good amount of buyer demand?
Yeah, I mean, I would say you're seeing a lot. I in terms of applications, they probably have slowed down over the market. It's tough to say individually, but just with people I've talked to, they've definitely slowed down. But you're seeing just a lot of, I don't want to say hesitancy, but just like, we're just thinking about it. We want to see, what we can do and just see if it makes sense. So I'm seeing a lot of that right now. But yeah, in terms of a slowdown, I would say as an industry, there's a lot of conversations about slowdowns. But
Mhm.
me personally, I'm still staying busy, which is good. But we could always be busier as well.
Right, right. We're never too busy.
Right.
But I think the other thing to keep in mind too, for people that are hesitant right now, is you gotta base so much of it based on your individual situation. It's extremely hard to time the market, and the people that are sitting there telling me that they want to wait, these shifts don't happen overnight. So you might be waiting a whole lot longer than you really think you are, and what you're waiting for might not be even as much of a shift as you thought it was.
Yeah.
So
Right.
just some stuff to keep in
Yeah.
mind.
I mean, dude, a lot of people, I'm sure people who said they want to wait in 2020 for the market to crash are kicking themselves right now because they got a house that was $20,000 cheaper with a payment that's $200 lower.
Well, and who was to know? Like, as soon as all that news came out, who was to know that that was going to lead to this crazy seller's market that we got into?
Yeah.
It was towards the seller's market, more of a neutral market in the Des Moines area before COVID happened, and it just inventory had gotten so low at a certain point, and interest rates were so low that there was just so much demand, and we haven't even gotten back in the Des Moines area. We haven't even gotten back to the inventory levels that we had pre-COVID. So,
Right. Well, and here's the first question. I just made a video on this, but the first question you should ask yourself if you won't even want to buy is could you live in this house for 3 to 5 years if you had to? Because you're not buying it's house isn't like Bitcoin, right? You're not buying it right
to
now
sell.
just to sell it. You're buying it to live in it.
Mhm.
But obviously, if you're not going to be there long term, if you're only going to be in a house for 2 years, then yeah, maybe buying isn't the best idea if you're actually concerned that the price is going to go down.
Yeah, and it's something to start thinking about too, is as much as people are sitting there hoping for a crash, don't buy expecting to see the appreciation that we've seen in the last 2 years,
Right.
because it's basically unprecedented. So don't buy, say, thinking that you're gonna get 10% return year after year. Like, it's just
Right.
not
If you get
not
10% over 2 years, that's pretty good.
Your before this, I mean, your average in Iowa, central Iowa was right around 4 every year.
Yeah.
So, and you could kinda bank on that. I always tell people to expect closer to the 2 or 3, and then if you outpace that, you hit the jackpot basically, and
Right.
you're feeling pretty good about yourself. So,
Yeah.
we could go to this next article, and this will be a
Sure.
little bit quicker because it's kind of we're kind of beating a dead horse, so to speak. We've already talked about this, but your second historic Fed rate hike that we saw last week,
Yep.
basically hasn't affected interest rates. It actually do you wanna kinda talk about what happened after the Fed increased the rate again?
Yeah, so, you'll see in the media, you'll see on TikTok, people who aren't in this space don't understand the Fed funds rate, the rate that they're raising it doesn't have a direct impact on mortgage. When they're doing that, they're doing, that affects like banks with HELOCs and credit cards and, personal lines. That's kind of what it impacts. What's what the banks borrow, let's just say.
Mhm.
So that stuff, obviously, the reason that they're raising it is to control inflation. The reason that mortgage rates are high right now is because of inflation. So obviously, you could say they're indirectly correlated, but when they priced in that 75 basis points, mortgage rates actually went down. I won't say it's the only factor because there were some pretty tough economic news that came out with that. But that just goes to show that just because it goes up 75 basis points from the Fed, mortgage rates don't directly go up. It's already priced in when it's going to
Right.
get predicted. So, but let's just say that the Fed would have raised it only 25 basis points, then yeah, rates probably would have gone up just because they were expecting the 75.
Okay. Interesting. 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 Interesting.
Yep. Yeah, because
Eh,
investors they want so the mortgage-backed securities or the 10-year treasury, um, those are long-term. They're bonds, so it's a long-term play. So if if the Fed isn't aggressive in slowing down inflation, and investors think that this is going to be a long-term thing, then yeah,
they won't invest in mortgage-backed bonds as much.
yeah,
So then you would need to increase it
or
for
they
sure.
won't invest in long-term bonds. They'll invest in short-term bonds, which is a indicator. So inverse yield curve is what that term is when people invest in short-term bonds more than long-term bonds, and that's a sign of a recession.
Okay. So that would be more stuff you could watch to get an idea of what interest rates are potentially going to do. My
Yeah.
advice is to give yourself less of a headache and just reach out to someone like Jared if you want to kind of track what interest rates are doing. Or there's plenty of news sources out there that you can kind of keep an eye on what interest rates are doing. Jared and I both are hooked up with tools that will be able to give you monthly updates and stuff like that too if you're interested in reaching out to us about that.
Yeah.
So
The best advice that you gave, Thomas, is if you can afford the payment as is with where the market's at right now, then it's as long as you're locked in, or if there's refinance opportunities, it's gonna get better because you make
mhm.
more money. If the rates go down, you can refinance, things like that.
And then your 3 to 5 year window that you're talking about there is a really good rule of thumb because more than likely in 3 to 5 years, you're going to be in a better situation as far as how much you owe on that house. The house is probably going to go up in value. And just those two things right there should provide you enough flexibility to really move if you have to.
Yeah.
And
Yep.
if in the worst case scenario that doesn't happen, there are other exit options than just selling your house. You can rent it. You can figure out other ways to hold and keep yourself and wait until you're in a better situation with
Heck yeah.
that house. So if you have any questions, don't be afraid to reach out to us. Jared, thank you so much for being on. We talked a little bit more about that than I thought we would, but I think it was a really good conversation.
I think this might be our best one yet.
I think we're getting in a flow. I don't want to brag too much, but I think that might be our best for that. Thank you everyone so much for watching. Leave questions, comments below, or reach out to any of us directly and have a good day.
Awesome.